There's a longer run shortage of housing in the United States, which there's nothing that the Fed can do about.
In places like Sacramento, home listings have surged by over 50% in just 1 year, while affordability has plunged to its lowest level since the Great Recession. Markets that soared during the pandemic boom are now unraveling, exposing trapped homeowners, stalled economies, and a looming wave of negative equity. The story you think you know about California's real estate safety net is about to be shattered, and the financial aftershocks could hit far closer to home than most people realize. Which cities are tipping into freefall, and why is the downturn happening now? The answer may upend everything you thought about the value of your biggest investment. California's reputation as a safe haven for real estate wealth is under assault. The state's housing market, once the envy of the nation, is now flashing red across almost every metric that matters to buyers, sellers, and investors alike. In June 2025, active home listings across California jumped 34% year over year, the sharpest surge since the aftermath of the Great Recession. For the first time in a decade, buyers are no longer chasing after scarce inventory. Homes are piling up, and sellers are left waiting. Affordability has collapsed to levels not seen since 2007. Only 15% of California households can now afford a median-priced home. The typical buyer faces monthly payments topping $5,400, a figure that would have seemed unthinkable just a few years ago. To qualify for a median-priced house, a family needs an income of $222,000, almost triple the state's actual median household income, which hovers around $80,000. For the other 85%, homeownership is no longer just out of reach. It's a fading dream. This is not the story most Californians grew up believing. For decades, the Golden State's housing market seemed immune to downturns. Even during national slowdowns, property values here always bounced back, driven by population growth, limited land, and the relentless pull of jobs and lifestyle. But the rules have changed. The pandemic-era boom, fueled by ultra-low interest rates, stimulus checks, and a rush of remote workers, pushed home prices far beyond what local economies could realistically support. Now, with those supports gone, the cracks are widening. The risk isn't limited to first-time buyers or young families priced out of the market. Many long-time homeowners, especially those nearing retirement, face a new kind of anxiety. The value of their largest asset is suddenly in question. Investors who once saw California as a guaranteed bet are pulling back, rattled by new regulations and the specter of falling rents. And while some markets, like select coastal enclaves or tech-driven cities, still show resilience, the reality is that broad swaths of the state are sliding into dangerous territory. This is a financial environment where mistakes can be costly, and hesitation can mean missing the window to act. For anyone relying on home equity for retirement, or those who bought at the peak, the stakes are higher than ever. The myth of endless California growth has been broken. What's unfolding now is a statewide reckoning, one that will test not just the resilience of local markets, but the financial security of millions. If you're watching from the sidelines, it's time to pay closer attention. And if you're already in the market, the decisions you make today could shape your financial future for years to come. Sacramento, once the poster child for California's pandemic housing boom, is now ground zero for the state's market reversal. In July 2025, active listings in Sacramento City hit 2,430, up 46% from the previous year. That's not a seasonal blip. It's the sharpest inventory climb the region has seen in over a decade, and it's reshaping every aspect of the market. Properties that used to vanish in days now linger. The median time for a home to sell has stretched from just 17 days last summer to 26 days now, a 53% jump. Sellers who once fielded multiple offers above asking are watching open houses go quiet and price cuts stack up. For longtime real estate agents, the mood has shifted from the frenzied optimism of 2021 to a new kind of anxiety. They're fielding calls from homeowners who bought at the peak, locked in with low-rate mortgages, but now find themselves unable to move without taking a loss. Many of these owners expected steady appreciation or a quick exit strategy. Instead, they're stuck. Their homes are worth less than they paid, and with mortgage rates hovering near 7%, even those who want to sell can't afford to buy again locally. The so-called move-up market has frozen in place. The numbers tell the story. In Sacramento County, homes are selling for an average of $530,000, down almost 3% from last year. The volume hasn't cratered, but it's stagnant. 1,020 homes sold in June, barely changed from a year ago, despite the explosion in listings. The market is oversupplied, and buyers are in no rush. Many are waiting for further drops, emboldened by the growing pile of unsold homes. The change is most visible in the city's lower and mid-priced segments. Listings under $500,000 have surged 74% year over year, while the $500,000 to $700,000 band is up nearly 60%. Even the higher end, once insulated by Bay Area transplants, is showing cracks. Price reductions have become routine, not rare. Sellers who hold out for 2022 prices are left chasing the market down, often through multiple cuts before a deal is made. Behind the data are real people recalibrating their futures. One local buyer, who relocated from the Bay Area during remote work's heyday, now faces a daily commute as her employer demands more in-person time. The math no longer works. She's underwater on her home and can't afford to sell, but staying means a grueling drive and a budget stretched by higher payments and rising costs elsewhere. She's not alone. Stories like hers are echoing across Sacramento's neighborhoods as the promise of pandemic-era flexibility collides with new economic realities. Agents describe a psychological shift as well. The urgency and FOMO that defined the last few years have evaporated. Now, buyers are cautious, looking for bargains, and willing to walk away. Sellers are the ones feeling pressure, especially those who bought in the last 2 years or need to move for work or family. The market has flipped from a sprint to a waiting game. Sacramento's rapid inventory growth and lengthening sales cycles aren't isolated events. They're the first evidence of a broader pattern playing out across California's interior. As remote work unwinds and affordability collapses, the gap between home prices and local incomes grows impossible to ignore. In Sacramento, the cracks are no longer theoretical. They're visible in every unsold sign and every anxious conversation between agents and homeowners. The city's reckoning is underway, and for many, the options are narrowing fast. Further south, the Central Valley is facing a reckoning that is hard to ignore. Fresno and Stockton, two cities that saw a surge of investor and first-time buyer interest during the pandemic, are now caught in a financial squeeze that local wages simply cannot cover. In Fresno, the median home price is now 8 times the area's median household income. That is a ratio more extreme than even the national housing bubble of the mid-2000s. For most local families earning around $58,000 a year, the idea of affording a $465,000 home is out of reach. Monthly payments on a new mortgage now eat up more than half of a typical family's pre-tax income. Even with price cuts, the math just does not work. Stockton is not faring any better. Once touted as an affordable alternative to the Bay Area, Stockton's home values soared as out-of-town investors and remote workers flooded in. But the local job market never caught up. Today, median prices hover near $420,000, while the city's median income sits below $69,000. That gap is pushing more and more buyers and sellers out of the market. Homes that would have sparked bidding wars in 2021 now sit unsold for months. Inventory in Stockton has ballooned 70% year over year, reaching more than 1,500 active listings this summer. Meanwhile, vacant homes are stacking up, and foreclosure filings have tripled since 2022. The investor pullback is no longer just a trend, it is a stampede. During the boom, nearly 1 in 4 Fresno sales went to investors, many betting on endless rental demand or quick flips. But as rents stagnate and vacancies rise, those same investors are racing to exit. Properties bought at the top are now being listed at a loss, and many sit empty as would-be tenants cannot afford the asking price. The same story is playing out in Stockton, where absentee owners are slashing prices to find any takers. In both cities, open houses are quiet, and price reductions are now the rule, not the exception. The consequences ripple through neighborhoods. Streets that were bustling with moving trucks 2 years ago now see "for sale" signs linger for months. Local agents report that even deep discounts, sometimes $50,000 or more off last year's prices, are not enough to attract buyers. Appraisals are coming in below contract price, leaving deals to fall apart at the closing table. For families who bought at the peak, negative equity is becoming a reality. Many are stuck, unable to sell without taking a loss, but also unable to refinance as rates remain high. What is unfolding in Fresno and Stockton is not just a correction. It is a full-blown mismatch between what homes cost and what people actually earn. Investors who once fueled the frenzy are now accelerating the downturn, dumping properties into an already saturated market. The promise of quick wealth has given way to a cycle of price cuts, rising vacancies, and mounting financial stress for everyone left holding the bag. And as these Central Valley cities struggle to find a new balance, the fallout is starting to spread to other markets that once seemed untouchable. Palm Springs, once celebrated as a playground for investors and Airbnb entrepreneurs, is now a cautionary tale for anyone betting on short-term rental gold rushes. In late 2022, city leaders drew a hard line, capping vacation rental permits at 20% of homes in every neighborhood. The law, passed as Ordinance 2075, did not just freeze new permits. It slashed the maximum number of rental contracts per property, forcing many owners to watch their projected income shrink overnight. For hosts who bought at the peak, the fallout has been swift and punishing. One former Airbnb, purchased for $1.16 million with visions of endless bookings, sat on the market for months. After 5 price cuts and 0 offers, the listing now reads $875,000, a $285,000 loss in less than a year. Stories like this echo across Palm Springs, where the once booming short-term rental market has cooled to a crawl. Inventory is climbing, with 872 homes for sale in May 2025, up from 630 the year before. Only 14% of local homes now sell above asking price, a fraction of the bidding war frenzy seen just 2 years ago. For many, the math simply does not work. Mortgage payments, taxes, and new city fees outpace what is left of the rental income. Investors who banked on double-digit returns are offloading fast, and buyers are in no rush to catch a falling knife. The regulatory clampdown did not just hit investors, it sent a chill through the entire real estate ecosystem. Neighborhoods once filled with weekenders and bachelorette parties now see for sale signs linger for months. Veteran hosts talk about the shift in hushed tones, recalling the days when a new listing meant a line out the door. Now, would-be sellers face a market where buyers are scarce and banks are wary. Even properties with existing permits are fetching less as the pool of eligible buyers dries up. Further east, Riverside County's housing market is facing its own reckoning. Inventory exploded to nearly 14,000 homes in 2025, the highest level in over 5 years. Price cuts are everywhere. More than 1 in 4 listings have been reduced, quadruple the rate seen during the pandemic boom. The region's growth story, once fueled by remote workers and investors chasing quick flips, has run out of steam. New neighborhoods, built for buyers who never arrived, now stand half empty. Commuter families, lured by affordable prices and the promise of space, are rethinking the trade-off as return-to-office mandates creep back and gas prices eat into household budgets. For one Riverside commuter, the reality is stark. The daily trek to Orange County now means hours lost in traffic and a mortgage that is barely manageable. When prices were rising, it felt like a smart bet. Today, with home values flatlining and the cost of living rising, many families are stuck, unable to sell without taking a loss, but unable to move closer to work without breaking the bank. Investor pullback and oversupply have upended the old rules. In both Palm Springs and Riverside, the dream of easy money has faded. The new reality is a market where sellers outnumber buyers, and desperation is starting to show. The financial whirlpool that began with a few policy changes is now pulling entire neighborhoods into its orbit, leaving both hosts and homeowners searching for a way out. Buyers who once rushed to outbid each other are now hesitating, and sellers who would have cashed out at the top are staying put. The psychology of California's housing market has flipped almost overnight. The fear of missing out that drove the frenzy in 2021 has been replaced by something colder, a collective pause, as both sides of the market wait for someone else to blink first. For homeowners, the numbers are paralyzing. Over 81% of California mortgages carry rates below 5%. Trading up, or even moving across town, would mean swapping a manageable payment for one that's 40% higher. On a $700,000 loan, that's an extra $1,400 a month, enough to lock millions of sellers in place. For many, the idea of listing their home isn't just unappealing, it's financially impossible. A retiree in Riverside, for example, faces a simple choice: stay put with a $2,700 payment, or move and pay $4,100 for the same house. Most choose inertia. Meanwhile, buyers are watching prices drift lower and inventory pile up. The urgency is gone. Instead of bidding wars, open houses end in silence. A first-time buyer in Fresno, once desperate to get in before being priced out forever, now wonders if waiting another 6 months might mean a better deal. With monthly payments on a median-priced home now topping $5,400, even those who qualify are holding back, afraid to catch a falling knife. This standoff feeds on itself. Sellers don't list, so inventory growth slows. Buyers wait for bigger price cuts, so homes linger even longer. The result is a self-reinforcing freeze. with both sides trapped by the math and the mood. It's a pattern California hasn't seen in a generation, and there's no quick way out. The hope for a bailout, or a quick rebound like California saw after the 2008 crash, is fading fast. Back then, federal rescue packages and a flood of distressed inventory eventually reset the market. Today, there is no comparable lifeline on the horizon. The roots of the current crisis run deeper. This time, it is not just about bad loans or a temporary shock. It is a fundamental mismatch between what homes cost and what Californians actually earn. To buy a median-priced home in California now, a household needs to bring in $222,000 a year. The reality? The typical family earns less than $100,000. That gap is not just wide, it is historic. Even during the worst moments of the last housing bust, the income required to buy a home never pulled so far ahead of what most people made. Now, 83% of California families are shut out of homeownership altogether. Lawmakers have tried to slow the influence of big investors. Assembly Bill 1240, passed by the Assembly in June 2025, would block corporations that already own more than 1,000 single-family homes from buying up more. But the bill is still winding its way through the Senate, and most investor activity comes from smaller players who are not covered. Meanwhile, even institutional buyers are pulling back, discouraged by tighter rules and the growing risk of falling values. For ordinary buyers and sellers, the numbers are relentless. Mortgage payments have doubled since the pandemic. Appraisals are coming in low. Deals are falling apart at the last minute. In some Central Valley cities, analysts warn that prices could drop by more than 30% before the market finds its floor. There is no outside force coming to prop things up. The market is left to correct on its own, and for many, that means bracing for even more pain ahead. In June 2025, California's Housing Affordability Index hit a historic low of just 15%, while active listings in cities like Sacramento surged by over 55% year over year. This documentary has revealed a pattern. From Fresno's 8 times income-to-price ratio to Palm Springs' 20% Airbnb cap, each of the 12 cities faces a unique but severe mismatch between home prices and local economic realities. The reversal of remote work trends, mortgage rates now locking out buyers, and investor withdrawals have accelerated the downturn. Yet the depth and duration of this crisis remain uncertain. No expert can predict exactly how far prices will fall or when confidence will return. What is clear from the data and documents is that many California markets are already in freefall, with negative equity rising and oversupply growing. For homeowners, buyers, and investors, the evidence points to a new era where past assumptions no longer hold, and caution is essential.